Hi, Carson. What's best about being here?
I love coming to the Sohn London conference. I've been coming here for almost consistently since 2012. It's a great conference in terms of the cause, raising money for pediatric cancer treatment and research. But I love London. It's a fantastic atmosphere. So, yeah, it's been a really enjoyable conference every year that I've come.
And what is your current market outlook at the moment?
Well, that's me. That would be me getting out over my skis. When I think about the markets, I take a very U.S.-centric approach. And so people will talk about the U.S. markets, the S&P 500 did this or that. I mean, to me, what's really important is to understand the dispersion within that index or the other major indices. And it's really a few companies that really drive it. So when you look at that over the past several years, it really hasn't been that healthy, despite what seems nominally anyway are strong gains. So you've had a lot of companies, the vast majority, probably 2/3, underperform the indices in a given year. So I don't think that changes. There are structural reasons why money flows to a relatively small number of these companies in the indices. And until you get a significant increase in unemployment, where people stop contributing to their retirement funds and actually take money out, I think that dynamic more or less continues. Yes, you can get some noise, you draw down like in 22 if rates are increased, but those structural factors are present. And so for the foreseeable future, I think the S&P, just on the back of these passive flows, will go higher, over the long term until something breaks. And so when you get that situation in which we have net outflows from retirement funds, the fragility that this has created is significant. So the equity markets at that point, all of this gets thrown in reverse. But those storm clouds are not on the horizon as far as I can tell. I'm reasonably sanguine about things. So despite, some volatility and air pockets that can occur in the near or medium term, I just, see probably up and to the right, on index level for the most part for the foreseeable future.
In Financial Times, they were comparing the Nasdaq 100 to the Great Depression, the dot-com bubble, the gold boom. Is that reasonable? Would you say that's fair?
No, because I don't even think that this is comparable to, say, the dot-com bubble in the late 90s that burst in March of 2001. The breadth of this just does not compare. It's reasonably narrow. Yes, you can look at some of these companies, or there are a number of companies, anything out there that's AI or, AI adjacent has a crazy valuation. But when this, to compare it to 1929 is extreme. When the market broke then, it had profound consequences for the economy. And also in 2001, when the equity market, when that bubble cracked, which was very broad, that did have profound economic consequences. So no, I don't think we have that situation. I don't think we remotely have that situation. The companies that are spending all this money, on data center build out, and they've issued bonds, sure, their CDS have jumped. I have some of my short seller friends who send me messages. Oh, look at Oracle's CDS, it's way up. Yeah, but they're still levered less than 4 times cash flow. Okay, this is not dangerous. They can handle it. So yeah, little mini bubbles within the space. Yes. When will they burst? I don't know. But I don't think that this is going to have a profound knock-on effect, beyond data center build out. And look, PS, those don't create any jobs anyway. So it's not that economically important.
And what is your biggest concern in the markets at the moment?
Look, I'm reasonably sanguine on things. There's a lot of volatility. Retail views risk as an opportunity to buy. I think that one of the things also, and it's not directly related to market structure, or it's not market structure itself, but it's an outgrowth, is that when you step back and think about it, there are really 2 generations of investors who've entered the market since the global financial crisis. So there is not an understanding or appreciation of risk. Now, again, I don't think that there's nothing there right now that's making me freak out about the markets, but that will become a problem at some point where we're just so anesthetized to risk that when risk does manifest, it's going to manifest very hard.
And how do you view the VIX at the moment? I mean, it's been up a bit and now it's coming down a small tad. How do you hedge against the volatility and the market risk that is out there?
Well, I mean, so what we principally are activist short sellers. So we do have other strategies that we're running, such as long commodities, and we also do run long. We have a long systematic momentum strategy as well, where we're long 20 S&P 500 names at any given time. But on the short side, which is where you really have to manage risk, we generally hedge by being long factor basket. So we look at each name that we're short. We run a software package that identifies the factors that supposedly drive its beta, and we try to hedge that. So we run, on the short side, we run market neutral always. I think you have to do that if you're shorting stocks.
And what are the most compelling growth drivers that you see right now?
I mean, in the market, just passive investing, because what has happened is, whenever passive gets an inflow, which is, every day it gets net inflows, it removes a supply of stock that's controlled by an active investor, somebody who's sitting there thinking, well, at this price, should I sell or not? And so by shrinking the supply of stock that's available, that's why you get with these names that are the very large and most concentrated names in the index or in the indices. That's why you get this parabolic effect. And that also gets turbocharged by share buybacks as well. So, that's not economic growth. And as I said, the vast majority of companies are still underperforming the indices, but nominally that's growth in the indices. So that's what powers them.
And you mentioned tech and the AI, but can you maybe talk a bit around it? What is your view about it? And what do you think about the data centers and if you find them sustainable, the investments?
So I really am not a tech person, but one thing that several years ago, somebody did a very good job of explaining to me what a large language model is. Okay, and based on that, and I've gone to tech people and done the prove me wrong thing. LLMs are not artificial general intelligence. And there's real debate as to whether they will lead to AGI. And I don't know. So maybe I'm just, throwing a dart here. But I suspect, so there is a view, and look, this is controversial. This is debated by people who actually know what they're talking about. But there is a view that we've gotten with these large language models past the point of diminished returns. And so it seems that each new generation of LLM kind of requires, it's like an inverse Moore's law. It requires almost 10x to spend on compute that the prior generation required. So what to me is interesting, and I asked some of these tech bro VC guys that I'm in contact with, so, with all these CapEx spending plans, by Microsoft and OpenAI, et cetera, like how much of this is going to be spent on data centers to train LLMs versus other forms of AI? And I was really surprised that, actually, they don't talk about that. And to me, that's a very interesting point because, there are, as I said, people who know what they're talking about in the space who think that LLMs are kind of pointless, to really spend money on them at this stage. So if that's what everybody is spending money on, look, these are well-capitalized companies for the most part. They're not going to crater as a result. Like Microsoft is not going to go down because it wasted a bunch of money on AI, but there's a very good chance that these companies are wasting a bunch of money on AI. So I guess that's how I look at it. I sit on the sidelines. We're sometimes long some of these companies in our systematic strategy, not because it matters what they do, because, who cares? It's a systematic strategy. But there could be somewhat, it could end badly for some of them.
And for my last question, when you go wrong in a stock or in a case, how long do you keep and hold on to that case, or when do you close it?
Well, we have a rule internally when a stock that we're short is up 30% from, so generally the only things we short are the subject of short activist reports. So we look at the price before a report was released. And so we have a rule that when it goes up 30% versus the price at which it was before the report was released, we have to trim. So that's when we start trimming. From when do we close a position and say, we're done? That's pretty subjective. It's, if we've made all the points we think we can make. And look, in an environment like this, this year, where, especially in the second half of the year, some things were short, just absolutely ripped. You're not going to win an argument because everybody's screaming back too loudly to listen to what you're saying. So in that environment, when we feel like we can't win an argument, then, we pick up the ball and go home.